Troubles at New York Community Bancorp are escalating. The bank announcing it's lost 7% of its deposits this month. The regional lender also slashing its dividend this morning to 1 cent. That's from 5 cents. And before that, down from 17 cents. Now, this all comes after NYCB announced a new CEO and $1 billion rescue plan on Wednesday. Shares moving higher this morning, up just about 1%. That slight edge up coming after a massive day of midday declines, at least yesterday, on a report that NYCB was looking for investors. The official announcement of that $1 billion infusion pushing shares back into the green. Here with more, we want to bring in Yang Tang. He's the co-founder and CEO of Arch Indices. Yang, it's great to have you here. So just talk to us about this $1 billion infusion. It's looking to regain maybe the confidence of investors out there that NYCB is going to be okay. Is it enough?
I don't think so. And I think, let's look at NYCB holistically. It's $117 billion in assets. It's actually got a loan to deposit ratio of over 100%. So if you actually factor in the 7% deposit outflow, you're probably closer to 110, 115, which is a very problematic place for a bank. Secondly, NYCB has $13 billion in commercial real estate and $37 billion in multifamily housing. And this is where the problems arose. If you think about what has happened to property prices as interest rates started going up, the cap rates have yet to readjust to the new environment of property prices. So at this point, $1 billion in a $50 billion asset is about 2%. So realistically, what is the confidence that the new management team, which seems like they've done due diligence for all of 2.5 weeks, have in where the loan book is going to end up?
What's the significance of the group of investors that have come forward versus another large bank making an outright acquisition of NYCB?
I think a lot of this was very much a headline investor. They have the former Treasury Secretary, they have the former OCC comptroller chairman there. They've worked together on IndyMac. They've been successful in the past. I don't think it's in the interest of the Fed right now to push a huge consolidation wave, because that's going to lead to criticism and fear that the U.S. banking industry is going to be over-consolidated. So if you actually look at the deal they got a very good deal given who they are.
Andrew, the 7% of the loss, NYCB lost 7% of its deposits in just 1 month. Is that maybe not as bad as the street had feared, given the massive trouble that the bank is in?
I actually think it's worse. The incremental cost of funding right now is extremely high. They were asked on the call today, what is the marginal cost of deposits? Avoided the question. Fed funds rate is 5.5%. So if you go to the Federal Home Loan Bank and you get a loan, you're going to be looking at 6%. The loan average yield on the loan right now is 5.72%. So every dollar they have to replace is negative on the net interest margin.
What is this foretelling about the rest of the commercial real estate sector right now?
I think it's very foretelling that there's going to be a lot more losses to come. The commercial real estate lending sector is the bread and butter business of regional banks. Everybody thought they were a conservative lender in 2020, right? Interest rates are 0%. You lend against a 4.5 cap rate on a Class A office space. Great. Today, 4.5 cap rate on a Class A office space gets nobody interested. And if you kind of look at where even multifamily prices have done, the prices have greatly appreciated income. So interest rates are up. The income from the property hasn't caught up with the property prices. And you sit there and you go, oh, I have a 60 LTV, I have a 50 LTV loan, I'm a conservative lender. Well, great, everybody's a conservative lender in a good environment, right? Who's a conservative lender in a bad environment?
So what does that fallout look like then?
I think a lot more capital raises are going to have to come. They're going to have to push consolidation. There's close to 5,000 banks in the United States. It's dominated by 4 large ones. The other 4,800 and whatever really live on scraps. So to make the business model work, especially in today's digital age, you have to have some kind of economies of scale to compete.
The company said on that call as well in the presentation that 80% of the total deposits are insured. What's the deal with the other 20%? Were they clear about that at all?
A lot of it is brokered CDs, wholesale funding. They have some money market accounts. They also participate in reciprocal deposits. I give you a deposit, you give me a deposit, right? The client is insured at 2 different banks, but in a way I didn't lose the deposit. So they have a lot of those types of programs going. They're all very expensive. And that's the point, is the marginal cost of funding right now for a bank is extremely high.
You closely follow the sector, clearly. You have a very close eye on a number of the regional banks. Are there 1, 2, or 3 that stand out to you that maybe could be next in terms of that risk and could be in a similar situation to NYCB?
It's really hard to predict these things because a bank fails when there's a run on the bank. And if you look at Silicon Valley Bank, First Republic Bank, nobody knew that the run was going to happen till it happened. And all banks are kind of similar. They also have very high commercial real estate, multifamily, CRE exposure, and they have high loan to deposit ratio. So if you want to go through and do a quick screen, who's got low capital ratio, high loan to deposit, and high CRE exposure?
Yang Tang, great to have you. Thanks so much for having on set with us, CEO of Arch Indices. Thanks.
Thank you so much.